Welcome everyone. I am James Moyna, and I'm glad that you were able to join us today for our Zoomcast, I'm calling it, regarding qualified retirement plans. And I'm going to talk a little bit about auditing in a remote environment. Kent is going to carry the bigger part of our presentation regarding fiduciary liability in turbulent times. And then we're going to talk a little bit about a charity that we're going to donate some resources to. And we're very happy that you are helping us make that possible for the people in the restaurant industry, which have been very hard hit by the current economic circumstances. I'll apologize in advance if there is any background noise. Much like yourselves, currently working out of a home office, and we have pets. So I'll kind of leave it at that. A couple of dogs that, if the doorbell rings in particular, that we might hear from. So I will just apologize for that in advance. With that, I'm going to kick us off. I'm going to talk about remote audits. Kent's going to talk about fiduciary liabilities, and then I'll wrap up. We'll try to take some questions at the end and have all of our topics covered before 1 o'clock. So I'm going to flip my slide. So when it comes to doing audit work remotely, I guess the big picture answer is yes, it can be done. But it certainly is not our preference. A lot of things under professional standards really are best done in an environment where you can do it face-to-face and in person. However, that is just simply not an option right now. So we're using technology to get around some of that face-to-face interaction. We have a secure portal that our clients are able to load documents to for us to audit. We use Zoom, and as I mentioned, I think the very first time I used Zoom was about 2 weeks ago. So learning a lot about how to use Zoom, still probably not very good at it. And it's been changing the software itself, given all of the new customers that they have. So kind of learning this as we go. One of the things, however, that auditing remotely and using technology has actually been helpful with and will actually increase quality for us on our audits is that we've recently been able to get a lot of payroll reporting in Excel format. And generally what I mean is a payroll file in Excel that includes every employee, every pay date, every field in payroll. And then we can, in many cases, test 100% of the population when it comes to the contributions being calculated via payroll, whereas historically we would have just tested a sample. So that's actually an area where technology has been great and helpful in increasing audit quality through the use of technology and actually adding both quality and efficiency to the process. In the current environment, there's a couple of things that plan sponsors, if you're not already aware of, should be. There's a concept under ERISA known as a partial plan termination. And unfortunately, there's no bright line test, but the guidance indicates that generally at about a 20% threshold of involuntary terminations of a workforce, that would trigger a partial plan termination. The impact on a plan-wide basis is not too significant, but on an individual basis is very significant. And that impact is that the affected participant would need to become fully vested. And we certainly have seen situations where involuntary termination, people are laid off, paid out, and then it's later discovered that that was actually a partial plan termination, that those people then have to be restored any amount that they forfeited and have a second payment distributed to them. So just want to make you aware of that a partial plan termination might happen if more than 20% of the workforce is involuntarily terminated. Also, there have been some changes in law and certainly in demand for withdrawals from plan assets by participants. In-service distributions, hardships, loans, etc., have become more prevalent and needing, bear with me a second, as I said, we're learning about the chat room. I'm going to come back to this question in a bit. What does it mean? Yeah, I'm going to come back to that in a bit, Andrew. So increased demand for distributions will be going on, and some things have changed. Loans, it used to be the maximum loan a person could take was $50,000. That's been bumped up to $100,000. It used to be that there was a 10% penalty on early withdrawals. That has been eliminated. So there's been both some law changes and an increased demand from the participants. Also, we've been talking to certain payroll providers, Paycor in particular, and it appears that payroll providers are helping plan sponsors and adding some pay codes to the payroll system to help track certain items as they pertain to the CARES Act. Which is great that information will be tracked and captured in payroll. However, we want to also make sure that plan sponsors are correctly implementing those codes when it comes to including them or excluding them from the calculation of contributions. So employee deferrals and employer match, those need to be coded in a fashion that's in accordance with the plan document. So just a caution there when making changes to payroll to make sure that it continues to comply with the plan document terms. A couple of efficiency ideas, and then I'm going to turn the discussion over to Kent. So a couple of efficiency ideas that we have for you, some ways that we might have to look at the audit differently, or some things that we might be able to help with, is that from an auditor side, we have for many years gathered data through web portals via TPAs, Fidelity, Vanguard, Principal. Many of the big TPAs have portals that an auditor can log into and gather data without having to interrupt the client. Same is true for many payroll providers, where we can just access payroll records through a web portal, again, not have to interrupt the plan sponsor or their operations, go directly to the system, gather the records we need, and do our testing. Now, it's read-only. We certainly can't be making changes to payroll, certainly would not want to have any access to make any changes. It's read-only, view access sort of thing, where we can get the reports and not have to bother plan sponsors for that information. Another thing that has come up recently is many of our plan sponsors aren't able to get back into their offices. So it makes records difficult to obtain in certain instances. So we're looking at things like direct confirmation with selected participants, where we would send the participant a letter and ask the participant to verify for us their hire date, birth date, etc., in lieu of some of the paper forms that we may have seen in the past. And then lastly, I just want to mention before I turn it over to Kent, just so you know, just educational wise, in case you don't, the fee for our audit is a fee that can be paid from plan assets. And it can be all or a portion of the fee. So 100% of the audit invoice could be paid out of plan assets, or maybe you only want to send a portion of it through the plan, 50% of it, whatever you deem to be appropriate. But it is an appropriate ERISA allowed, so to speak, plan expense that could be paid out of plan assets. That might be good information for some plan sponsors that might be having some budget constraints given the current economic situation. Just wanted to mention that so that you are aware. Many plans currently pay, the record keeping, investment consulting, all those sorts of fees out of plan assets. The same sort of thing could be done with audit fees if you should so choose. With that, I'm going to kick it over to Kent. Kent, are you there? And
I am.
very good.
You can hear me okay?
Yes, sir.
Okay. Before I get started, just quickly, I've been in the business 35 years, really over 35 years now. And I started my career as a bank trust officer for employee benefit plans. And from there, I went to work for RSM McGladrey in their retirement plan administration and consulting group. I was there for over 10 years. And in 2000, I started my own independent registered investment advisory practice down here in Raleigh, North Carolina, where I concentrated 100% on qualified retirement plans, providing investment advice and employee education. And it was very successful. And I sold my interest in that 5 or 6 years ago. So I've been in the business for a long time, and I've had experience from just about every angle. Joined JMM and James Group here over a year ago in the plan audit side of things. So as I go through this presentation, I just wanted to give you a little bit of background, a little bit of information about my background. So
that long experience, Kent, probably explains the gray hair.
I don't have any gray hair. Do I have gray hair?
Okay. Just so you guys know, I've known Kent for probably 30 years. Kent and I started our careers at the McGladrey office in Rockford many moons ago. So we've known and worked together for a very long time, and we're happy to have him as part of the team.
Thanks, James. Getting started here, when we were thinking about the topics we should be covering at this particular time, we at first thought about maybe covering the issues or the regulations that came out with the COVID legislation, and we thought, well, that's overkill. Everybody's hearing about that. And one of the things that I thought probably would be very important and timely would be to talk about our liability as not only plan sponsors, but as service providers to these retirement plans, because quite honestly, we've never seen market volatility anywhere like what we've seen this first quarter. And employee anxiety with regard to their retirement plans is higher than I'm sure it's ever been before. I've got friends asking me all the time what they should be doing with their retirement plan account balances. And as such, plan sponsors, employers, as well as service providers, the exposure to liability, in my opinion, has never been greater than it is now. So I thought it would be a good time just to touch on ways to protect ourselves during this period and going forward. Want to go to the next screen here, James? Thank you. The three entities, if you will, or concerns that we have as plan sponsors and service providers in terms of compliance and liability, of course, Internal Revenue Service, the Department of Labor, and both current and former participants. And I should say current and former disgruntled participants. With regard to the IRS, they typically, although they are doing random audits, they typically are going after plans that have what we call high account balances, average account balances. Their low-hanging fruit, if you will, are the small professional groups with the real high average account balances, like medical practices and engineering firms. That seems to be their of all the areas they do touch on, that seems to be one of the most popular. In the 35 plus years I've been in the business, I have never had a single client be audited by the IRS with regard to the retirement plan side of things. Department of Labor, we've obviously got exposure to the Department of Labor regulations, but as some of you or most of you may or may not know, the Department of Labor does not do random audits anymore. They haven't been doing random audits for years. The Department of Labor indicates that they are busy. They have more business than they could possibly ever try and get out through their own on random audits through complaints filed from disgruntled participants and former participants. So the biggest exposure for us all is those that we're trying to serve, obviously, which is the plan participants. Next slide, please, James. "20 years ago, the number of lawsuits and attorneys that were fully committed to litigation in retirement plan business is small. It was pretty much limited to the large firms that were going after the large companies like First Union Bank that used to be in business. They've been acquired now by they acquired Wachovia, and other large companies, particularly those that sponsored defined benefit plans, and the underfunding of those plans was a big issue. It's been slowly changing over the years, and today it's a totally different story. And the numbers continue to grow in terms of those that are being challenged with regard to their plans, and those that are challenging. In other words, the law firms that are focusing on plans. Today, in the legal industry, I believe they call it, you concentrate in 401k mismanagement, seems to be the term that is widely used now. And if you go on the internet and look for law firms that concentrate on 401k mismanagement, the list is endless. It's growing. And the plans that they are challenging or representing class actions against are smaller. These are smaller plans now. In 2018, the total settlement in these suits was approximately 291 million. 2019, it was 559 million. In 2017, it was near those same levels. Half of those lawsuits had to do with excessive fees. The average settlement was about $12 million. So if we can go on to the next slide here. One of the targeted areas in these lawsuits are asset-based fees for record keeping and administration services. And what do I mean by that? If you've got a retirement plan that is being administered and the statements are being provided by a third-party record keeper, and their fees are asset-based or based on a percentage of your assets, the issue is, why would someone with a $100,000 balance be required to pay 10 times the fee for record keeping and administration than someone with a $10,000 balance pays? It makes sense. They shouldn't have to do that. So those types of arrangements are being looked at and challenged. And where it gets really interesting is where we have retirement plans that are being run or administered by bundled service providers, where we've got both the investment management, the investment lineup and mutual funds, as well as the employee communication and the record keeping and the administration and the custody and trustee services all being provided under one roof. It gets real murky there because it's difficult to separate services from fees. So my personal opinion is, if you have a plan that currently is being managed or handled by a totally bundled service provider, there's absolutely nothing wrong with that. However, I would be asking questions about how the fees that are being charged are being allocated internally. What are they being used for? How much is for employee communications? How much is for record keeping? And how much is for custody? And have those answers documented, because if you get challenged and you're asked those types of questions and you don't have answers, you're going to be in trouble. Another area that's being focused on is actively managed versus passively managed funds and the fees that are being charged under both arrangements. What I mean by actively managed is if you've got a mutual fund that is being managed by a fund manager that is not mirroring any kind of index, but they're just picking and choosing stocks with the goal of beating their comparative index. In other words, if we've got a large cap fund manager. Their index might be the S&P 500 that we compare them to. Their whole purpose in life is to beat that index or to beat their peer groups, if you will. Passively managed funds are those funds that are simply index funds. For instance, the Vanguard S&P 500 index fund. Fund managers and fund management groups that manage passively managed funds primarily are responsible for just making sure that those underlying holdings mirror the underlying index. An example of the S&P 500. And it's more of an accounting function. If you have, excuse me, if you have funds that have high internal fees or funds that are performing lower than their comparative indexes, it's another targeted area. And I'll go into more detail in that in just a moment. James, if you can move forward, I can. On the actively managed funds versus the passively managed funds, where I think advisors and plan sponsors are going to have the most exposure is when you've got a plan that is not indexing, but it actually consists of mutual funds that are being actively managed by managers, and you've got an investment advisor, or you are an investment advisor providing advice to this plan. And you've got, for example, a year that ends where you had a portfolio that earned $500,000 in total returns. And if the underlying indexes on a weighted percentage, in other words, if all the money had been invested in their relative index funds as opposed to the actively managed funds, and the return would have been $490,000, it means you only beat the indexes by $10,000. If your advisory fee is $15,000 or $20,000, that's going to be a hard thing to defend. Either whether you're the provider or the plan sponsor. So it's very important that when you look at the way your investment assets are being, or your plan assets are being invested, that you have a very good understanding of not only how the funds are performing, but how they're performing with regard to their underlying indexes or comparative peer groups. One of the areas that I am finding more prevalent, what I had realized when I came to work for JMM, is that a lot of plan sponsors don't have retirement plan committees in place. And one of the best ways to protect yourself, either as a plan sponsor or as a provider, is to obviously have a retirement plan committee in place. And it's not too late to do this. In fact, I'm shocked at the number of plans that we take over as the new auditors that don't have retirement plan committees in place. It's not too late. The only time it's too late is if you're on a ship that's sinking. Then it's too late to worry about whether you have enough life jackets and safety boats. But it's not a sinking ship yet, so it's very important. If you don't have a retirement plan committee in place, you need to have one put in place. You need to formalize it. And what do I mean by that? Either it's your first retirement plan committee, make sure that the minutes consist of the names of those who are going to sit on the committee, or some employers take it as far as having a retirement plan committee charter that they adopt. Either one is fine, but you really should have a committee that is named and formalized. The second thing that you need to do to protect yourself, both plan sponsors and advisors, is to adopt and follow a written investment policy statement. Another area that we just don't see uniformly being applied. Again, we have a lot of plans that we take over that don't have investment policy statements in place. They may have a retirement plan committee, but no policy. Well, the question is, if you get challenged, and again, we're in these times, turbulent times, where the environment has never been more right for being challenged as a sponsor or a provider. If you don't have an investment policy statement in place, you don't have any rules. You've got no guidelines. So if you've got investment options in your plan and you don't have any blueprint to follow as to when those funds should be switched or even what funds should be offered, if there's nothing formalized in a written policy, you can't defend yourself. You've got nothing to hang your hat on. Third, meet regularly. What do I mean by that? Annually, if you only meet once a year, at least you're meeting. Preferably, you would be meeting semi-annually or quarterly. And lastly, create and follow an agenda. Don't have meetings where you just fly by the seat of your pants. Every meeting you talk about current issues. You need to have an agenda that's consistent so that you have things to check on. Relatively speaking, you can see how things are performing against prior meetings. Document committee members, indemnify those committee members with fiduciary insurance. If you're on a retirement plan committee, you have personal liability. If you're a fiduciary to your retirement plan in any way, form, or shape, you have fiduciary liability, and it's personal. You're personally liable. So I would strongly suggest that you purchase fiduciary insurance. It's not expensive. The corporations usually purchase it for those that are on the retirement plan committee, and it will protect you in the event of a suit. Think about purchasing a personal umbrella policy on your personal lines. Again, it's not very expensive. It's an added layer of protection. I think it's areas or things that people don't think about when they are sitting on these committees or in management functions in these companies that sponsor plans. Again, as I mentioned, meetings quarterly, semi-annual, or at least annually, and follow the agenda. If you're going to follow, or if you have a retirement plan committee and you're following an agenda, here's a suggestion on what a sample agenda would look like. Usually you would start off with, what are new issues? Do we have anything that is going on this quarter or the last 6 months that we need to discuss? This is a very good time to invite the payroll person who's in charge of withholding the deferrals from the paychecks and depositing them or having them wired or ACH credited to the retirement plan trust. You would be surprised at how many people are in charge of payroll or who are actually performing the function where the payroll is, where the 401k deferrals are being withheld, who have never had anybody sit down with them and go over the adoption agreement, or go over what the definition of compensation is, or explain to them how to read a summary plan description. They've got a lot of responsibility in these positions, and unfortunately, they don't find out that perhaps they weren't supposed to be withholding 401k deferrals on bonuses. Their answer is, nobody ever told me that. So invite these people to the first part of your meeting anyway, and ask them if there's any issues that have arisen with regard to deferrals, and make sure they understand what the definition, at least what the definition of compensation is, so that the proper amount is being withheld. Discuss current issues with vendors. Are there any issues that have arisen with vendors? Any problems, any complaints? Have there been any participant complaints from the employees? Document what the participation rate, how many are actually contributing to the plan, and document what the average deferral rate is. If you've got a low participation rate, think of ways you can improve it and bring it up. If you've got a low average deferral rate, think about ways you can improve it or increase it. Discuss and document the status of the employee communications program. Do you have a policy in place as to how many times someone's going to be available to speak with your employees? You may have a company that's got too many employees to warrant shutting down and having meetings all day long of 30 participants or 50 participants attending. That in some instances it's just not feasible, but it's always feasible to have someone on site from your providers that can be there to answer questions for your plan participants. I used to have a policy in place that we would go out and meet with our clients, our employers, every 6 months. And whenever we would call to schedule that meeting, once in a while, the employer would say, oh, well, nobody has any questions, you don't need to come out. And I would always say, well, that's all right. Just give us a conference room, we'll set up. We're going to come out anyway. We'll be there from 8 a.m. to 6 p.m. And they would insist that nobody had any questions. I would insist that we were going to come out anyway. So we would go out and set up at 8 a.m. It's amazing how many people would show up with questions. They come and ask questions. If you're there, they'll come and ask questions. So make people available on a regular basis for your employees and your participants. Document your investment performance, obviously, and how it's performing against benchmarks, whether those benchmarks are indexes or category averages, in other words, peer groups, how your large value manager is performing against all other large value managers in the industry, as an example. And document at least on an annual basis, and that's all I generally have done and typically advise clients to do is on an annual basis, document your plan expenses and your compensation arrangements with your providers. With regard to plan expenses and compensation analysis, again, considered one of the highest areas of risk to plan sponsors: costs, fees, expenses, whatever you want to call them, versus compensation. The costs or fees are separate and distinct when evaluating fees for service. They're separate and distinct from compensation. They're two different things. They may be 100% equal, but you need to look at both items, and I'll give you an example in a minute. You need to look at both items in regards to trying to come up with documenting the analysis. Let me show you an assumption here. Let's say we've got total assets in a plan of $12,300,000. We've got total loans maybe of $150,000 and total participants of 450. How do we document our fees? I'll go through an example here and show you how to do that. Investment advisory fees. We've got $12,300,000 in assets. Deduct the loans, and we've got billable assets of $12,150,000. Now, many advisors are charging on an asset based arrangement. In other words, a certain percentage of total assets under management. That practice is slowly changing, and more advisors these days are going to a fixed fee. In other words, $10,000 annually, or maybe depending on the size of your plan, $7,500 a quarter. So it might be a fixed fee there that you would document, but you would then have a total fee there of $56,498. This is where I'd like to interject an example on investment advisory fees. Also, fees being charged by anybody that comes out and does employee communications or meets with your participants on a regular basis, enrollment and communications. One of the areas that are being challenged with regard to lawsuits and fees for services, again, it has to do with compensation, is if you've got someone, or if you are someone who's providing services to a plan, let's say you're an advisor, financial services advisor, and your fee on an annual basis is $50,000. My biggest fear when I was running my practice was that, and I charged on an asset-based arrangement. It wasn't a fixed fee. We were about to go fixed fee when I sold out, but we were at the time on a percentage basis. My biggest fear was that I would be sitting in front of a management group and they would be going through their P&L, their profit and loss statement, going through all their service providers, their accounting fees, their legal fees. They get down to investment advisory fees on the retirement plan, or they would be looking at their internal cost on the retirement plan, and they would get to my fee, $50,000. What did you do for that fee? Well, I had semi-annual investment meetings, and we're monitoring your investments on an ongoing basis. Well, $50,000 is a lot of money. How much time did you have? How many hours did you spend on our plan? That question alone scared me to death because we weren't tracking time. And I didn't know how I would answer that question, which really got me thinking about going to a fixed fee. So if you're in the advisory business or financial services business, or your plan is being handled by someone in that business, that's a discussion you need to have, because the bad time to have that discussion is when there's somebody else in the room and you're being deposed and they're asking you that question. You want to have those things ironed out in advance. So compensation for services is something that is very important, not just total fees, but what if someone's earning dollars and they're out there meeting with your participants or providing investment advisory services, what are they doing for that fee, and is the fee reasonable? So that's one example. Record keeping fees, how do you break this down? Here's an example of a record keeper that charges both a base fee and a participant fee and an asset-based fee, which is not uncommon. I'm not going to name the provider, but we've got a provider who's prevalent in the Chicagoland area who charges a base fee. They have the proprietary mutual funds in the plan always. So they have the internal fees being charged, which are asset-based fees on their retirement plan. And they have a per participant fee. So if you look at this particular arrangement, if you line item it, you got a fee on an annual basis that's $17,220. Next type of service provider in your plan, if you please, James, if you would go, there you go, would be your custodian and or your trustee. Again, custodians or trustee services, custodial or trustee services, there's a fee for it. Whether it's blended or not, there's still a charge for it because it's a service being performed. Total assets, again, 12,300,000, base fee of 500, 6 basis points. That fee would be itemized there at $7,800, $7,880. Next fee, this is the last one. Document your mutual fund expenses. Again, same amount in assets, average fund expense ratio. There's 2 ways to do that. You can either do a straight average. In other words, take the 12,300,000 and divide it by the total number of all the funds that you have and come up with an average expense ratio, or do a weighted average where you actually multiply the expense ratio in each fund based on the fund balance and come up with a cost that way. In this particular arrangement, the fund expenses come out to $88,000. Revenue sharing needs to be deducted. That's a whole different topic. If you may know what revenue sharing is, you may not know, but it's where mutual funds have agreed to credit some of their fees back to service providers. I don't like it. I've never liked it, but it's become a very big part of the business. You need to reduce the amount of cost by that revenue sharing amount. And here you might have a total net mutual fund expense of $76,000. Here's an example of how to put it all together. If you had this in your minutes for your retirement plan committee meeting, I think you would be, now whether or not they're considered reasonable or not is another discussion. But if you went this far to document your fees in this particular format, I think you would be doing yourself quite a bit, it'd be quite an advantage to you to have this in your file. And all I did was just summarized each one there in basis points and then in total dollars. Unfortunately, in the retirement plan industry, even service providers, and I was one of them, I'm included in this group, we like to talk in terms of basis points. If you've got 100 basis points, that means it's 1%. Basis points are meaningful to us if we're used to talking in those terms and we can convert them in our head to dollars right away. For most plan sponsors, basis points really don't mean much. It's important that we convert it to dollars. If you did a total analysis on your plan and it came out to 1.36%, okay, that's what our total fees are on assets. What is that in dollars? Well, it's $143,000. Oh, okay, you kind of look at it a little bit differently when you look at it in dollar terms. So it would be to your advantage to document fees, something in a way similar to this. I think that's the last. Is that the last slide, James?
It is.
Okay.
Thank you very much, Kent. That was very helpful. We've got some questions in the chat that we're going to try to get to here in a moment. But I wanted to touch on this, which is kind of the fun component of today. It relates to giving back. We've kind of looked out at the landscape with the things going on and how it's impacting people, and it's having a quite negative effect on some people, certain industries, etc. So a big component of what we do, it's part of our firm tagline. Our firm tagline is planning ahead, which we talked a little bit about earlier. And the second component of that is giving back. We like to look into the community and find some ways that we can help. And we noticed an organization that was just set up just recently to help workers in the restaurant industry. I checked this out. It's actually been set up and is being helped out by an organization called the National Restaurant Association, which I found to be interesting. That's an old client of mine from my former firm. So when I first saw this come out, I thought, well, you got to be kind of careful with some of these charities that pop up in times of tragedy. Is this legitimate, so to speak? So I called up the partner that is currently serving on that account and verified it with him, and he gave it his seal of approval. Said, yeah, this thing is real. What's going on is they have set up what's called the Restaurant Employee Relief Fund. It allows restaurant employees to go on into that fund, and I think they can each get a $500 check to help them through these difficult times. We initially, when we set up this program, said, you know what, we're going to give $50 per registered attendee to support this program. I am happy to say that we had room in our budget, and what we did just this morning is we made a donation of $2,000 to the Restaurant Employee Relief Fund, and that we would like to open this up to some of the people on this call that might like to do something similar. So we donated $2,000 this morning. We have another $2,000 in our budget that if any of you would like to contribute to this fund, we will match your contributions dollar for dollar. So the website is there. It's www.rerf.us. That's rerf.us. You want to go on and make a donation, maybe just send me a quick email, say, hey, we donated X amount of resources today. We will match that up to the first $2,000 that comes in from the participants on this call today. And we're very excited to be able to do that. So thank you for your participation in that. And we look forward to being able to help out the folks in the restaurant industry. I'm now going to turn off my sharing and see if we get over to our chat screen and read some of these questions. Maybe Kent, you've already seen some of these. Are there a couple there you want to talk about?
I'll go ahead and address these really quick. The first question is, what is the recommendation for how often the committee should meet regularly? My personal opinion on that is at least twice a year, semi-annually, except when we're in an environment like we're in now. I think it's very much warranted to meet quarterly. I know that's when you're trying to run a business, having a group get together 4 times a year is somewhat of a challenge. Maybe with the technology the way it is now, and we're all using Zoom and that things similar to that, it might be easier. But when my personal answer to that, or suggestion on that, is right now quarterly and quote normal times and quote semi-annually. We have another one that says, hooray, he's someone who realizes the importance of the payroll person and plan administration. Yes, we do. Bless you. You have a lot of responsibility on your shoulders. And we do understand how important that is, the function you perform. You're very welcome. Another one, will you share the slides, please? For a small additional donation, we'll be more than happy to do that. No, we'll share.
Yeah, we'll share the slides, of course.
Question, why is loan balancing excluded when calculating the investment advisory fee? That we excluded it when we charged our investment advisory fee because we felt that the funds were not invested in the loans were not actually invested in the funds themselves, and if we're an asset-based fee, it was our personal philosophy that we shouldn't be charging an asset-based fee or an investment advisory fee on money that's invested in loans. We're really not doing any analysis on that money. However, if you look at it from the standpoint is that fee also covers employee communications and the other things you do for the retirement plan, then of course it might make sense to charge it against loans. I know in this market down here in the Southeast, we don't see it very often where the loans are included. They're usually excluded. Doesn't mean it's right or wrong, but that's the reason for my excluding it from the calculation. We had to thank you for the donation. Of course, you're welcome. Well, let's see. I think that's it for the questions. I don't think I missed anything.
Awesome. Well, I had just one last thought that I would like to share. I'm going to try and get this back up on the screen, but again, my Zoom skills are not that great. And then, of course, we got one more coming into the chat room. We're going to take that last question sent in after the course. We'll get back to you with your question. So I'm just going to wrap us up with a poem. It's a poem that I first heard. I don't know if you've ever seen the movie Coach Carter, but I love sports movies, movies about young athletes overcoming obstacles and whatnot. And this young man recited this poem in the movie. So I looked it up because it really, quite frankly, it touched my heart. And I think it's got a lot to do and says a lot about things that are going on in the world right now. So I'm going to wrap up with this poem, and then I'm going to let you get about your day. So this poem is titled Our Deepest Fear, and it was written by Marianne Williamson. It says, our deepest fear is not that we are inadequate. Our deepest fear that we are powerful beyond measure. It is our light, not our darkness, that most frightens us. We ask ourselves, who am I to be brilliant, gorgeous, talented, and fabulous? Actually, who are you not to be? You are a child of God. Your playing small does not serve the world. There's nothing enlightened about shrinking so that other people won't feel insecure around you. We were born to make manifest the glory of God that is within us. It is not just in some of us, it's in everyone. And as we let our own light shine, we unconsciously give other people permission to do the same. As we are liberated from our own fear, our presence automatically liberates others. So I just want to sign off. I'm James Moyna. Thank you, Kent, for your contribution, and the entire JMM team for all that you do. We're going to sign off, and we're going to encourage all of you to let your light shine. Thank you again for joining us today and all that you've done.
Thank you.